So, very good afternoon, dear students. The topic that I'm going to take up for discussion in this particular lecture video is foreign direct investment, or FDI, in international business. Right, as we all understand that due to the impact and influence of globalization uh, and the scope that international business offers to various companies to expand internationally, one of the ways by which firms go about investing in foreign companies is through foreign direct investments, and this is the means by which a lot of developing and least developing countries are opening up their borders to foreign companies to come and make investments through the FDI that they open up in various sectors for investment, calling in for mutual development and understanding between these two countries and these companies. So let's look at in detail, what is FDI, what is the kind of role that it plays in development of an economy, and we'll also be looking and discussing about the different types of FDIs that are available within the country for companies to invest. So let's understand what this concept of foreign direct investment means. Foreign investment, as we all understand, has emerged as a very potent tool for the rapid economic development of countries in the developing and the least developed countries. That's because a lot of these developing and least developed countries do not have a capital of their own to build the necessary kind of infrastructure that is required for several companies to really flourish domestically. So FDI is one way by which they are able to bring in a lot of foreign investment into the economy, which can be invested in a lot of infrastructure developments and thereby helping companies to develop in the long run. So foreign investment means the investor puts in foreign countries and companies invest a lot of money from their country into the local company in expectation for very good returns. So foreign investor can mainly look at two types. Those who are interested in making a long-term commitment in the form of a joint venture, or those who are looking at short-term commitments of just putting money into portfolios or stocks and then recovering that whenever, or selling it off at whichever time they would want to, when they are in need of money as such. So there are a lot of short-term interests that investors have, and there are also many who have long-term investment in long-term investment motives as such. So FDI in today's globalized era plays a very extraordinary role in the expansion and diversification of global business, particularly for developing and least developed countries. And India is one of the largest beneficiaries of FDI, is because of a lot of a shortage of domestic capital that we have, which needs to be invested into growing the economy as such. So, and that is kind of taken care by foreign direct investments. So FDI also helps a company in accessing new markets, exploring new marketing channels, exploring cheaper production facilities in low-cost destinations, accessing new and advanced technology, planning differentiated high-quality products, upgradation of skills, and financing of future forays. So what it also is beneficial for those investing companies is this offers them a very good scope for expanding into foreign markets and thereby targeting a newer set of customers and clients through the FDI. And many developing and least developed countries also offer a lot of tax holidays. They offer a lot of SOPs, and there are a lot of very investment friendly schemes and initiatives and the policy that the government makes in these countries to open up their borders for foreign investment to come in. So they are inviting foreign companies to come into their own respective markets and establish business with companies therein, thereby helping those companies and also helping the economy to also, in a way, progress. And for the investing company, it's another easier way by which they can expand into international market. They can set up businesses in as many subsidiaries in as many countries as possible. And FDI is one route that they can possibly take. So foreign investment also benefits the host country or the foreign firm by investing in which they provide. It provides them a source of new technologies, capital processes, products, organizational technologies, and management skills. So there is a very mutual understanding and interaction that takes place when both these companies are able to invest and come together in order to ensure that they are able to develop something that is going to be mutually beneficial for both the companies and for the clients and customers that they respectively serve, and for the countries in the long run. So, foreign investment has been used as a catalyst in developing countries with a strong impetus to attract a lot of foreign investment into the country, which can be where then the money and the investment can be pumped into a lot of projects and into a lot of infrastructure development and into entering into areas where the the government, the local government has not really forayed, or local companies have not dared much to enter into those kind of sectors and industries which call for deep investments and huge investments over a long period of time. So, foreign investment in its classic definition is defined as a company from one country making a physical investment into a building or an asset, or into the or investing in a company in a foreign country. So, in a globalized era, it definitely really helps because globalization is making it possible for more and more companies to get influence and also take the opportunities that international business is offering to them. So, it's no longer serves good for companies to stay domestically and just cater to the domestic market, but it is wise enough for companies to see that they take the opportunities and the scope that is offered by several countries and companies around the world. And then FDI is just one route by which they can very easily enter into foreign markets and get a foothold, and then gradually get into serving those markets and slowly make it really big in those markets. So, foreign investment in another country or foreign firm may take many forms, such as a direct acquisition, of a foreign firm. So, which is through an acquisition, or it can be possible through setting up a new construction facility or starting business from a scratch in the form of a greenfield project, or entering into a joint venture, wherein depending on whatever is the foreign direct investment limit that is fixed by the government of a foreign country, so that much amount of ceiling investment can be made, and they can have a domestic partner with whom they can jointly work. So, foreign investment may also be in the form of strategic alliance with a foreign firm with an attendant input of technology or technical know-how, licensing of intellectual property, or entering into a management contract or a turnkey project. So, that's also a possibility wherein the foreign firm can enter into a strategic alliance with the domestic firm in some particular area or sector, or when they are jointly developing a new technology or jointly developing a new business or a project that both are a little new into, and both do not want to take the full risk. So they can jointly come together and leverage each other's know-how, capacity, transfer of knowledge, and jointly work together to see how they can build a new prospect in a new business that is new for both the firms. So, what are the advantages? Foreign investment is very important in the context of a developing country like India, which has abundance of two factors of production, that is land and labor. So those are two big advantages that India has in terms of the factors of production. And entrepreneurship also is another third factor that is emerging, which is really potential for the growth of Indian companies. And then foreign companies can make use of this third factor of production that is emerging, something that we've seen in the last 10 years. So the kind of advantages as FDI offers to a nation is it very easily helps in integrating the firm with the global economy. As I told you, a domestic firm can expand internationally and become an international company, become a multinational corporation, become a transnational corporation, and then finally go on to become a global company. So FDI route is one easy route that they can take by which they can integrate themselves in the global economy and expand internationally. Secondly, upgradation of technology and advancement of technical know-how also is really a very emerging aspect, because it helps when you join hands with superior firms or firms that are working on that particular respective nascent technology, and if it's at that very early stage, then definitely that's a big advantage. Thirdly, it increases competition and improves productivity by investing in foreign companies, and also catering to larger markets. For example, one of the advantages that India has is India uh, just does not offer you resource advantage, but it also offers you the consumption advantage in terms of the large market that is there in our country. Close to around 400, 500 million people, could be your end users. I mean, if you look at a, a B2C kind of a statistic of what kind of goods you can sell to the final user, at least about 450, 500 million potential users are what we are talking about in a country like India. And then fourth of all, yes, it definitely develops human development. It definitely develops the uh, human capability, uh, the capacity and the potential of a particular nation's workforce also increases when foreign companies come into the market, or when foreign companies enter, and then local, along with the local companies, the local talent pool also gets exposure. So one of the finest examples that we have is that of the IT and the ITES industry, with a lot of foreign companies making investment in IT and ITES. The kind of transformation that India has got, wherein it has emerged itself into a software giant, a software a country, that has the potential to be the leader when it comes to software development, research and development, and then also has been able to show the world of the kind of talent that we have in our software development, in terms of the engineers, the high quality engineers that we have to offer to the world. And then several businesses today are setting up their businesses in India, and taking and making advantage of this high quality workforce that we have in our country. So these go on to explain all of that. A couple more advantages. Yes, foreign investors come with improved set skill set to perform in a particular industry. So thus, the host country is benefited from the training and the skills and upgradation of a foreign investor. So the point in place is, it's not just that investment, it's not just that physical money that's coming into your company. You're also getting to interact with foreign companies, foreign entrepreneurs, uh, and so thereby there's a great advantage that we can learn some of the most latest advanced technical knowledge, business know-how, and a lot of transfer of knowledge can take place. Transfer of knowledge and competency can take place, and that can definitely boost the local company as well as the local skill set that we have within the country. So some of the other advantages of foreign investment are access to a large market for foreign investor in the host company, and foreign investor also has advantages to tap some of the most affordable resources that a particular country can offer, in terms of labor, in terms of land, in terms of technology, in terms of uh, know-how, and in terms of a lot of capability that local market can offer, which was not there for a foreign company when it was operating in their own respective country. So foreign investor also has the benefit of expanding their capacity, which can naturally give them the advantage of an economies of scope and economies of scale. So something that they did not have in their country. So this is a example of a firm that has a very high capacity of expanding and reaching out to a market, but it has a domestic crunch, wherein it is not possible for this firm to expand in the market. Possibly because the market size is small, or possibly it could be because they've reached market saturation, and there is no scope for them to sell furthermore and get the advantages of economies of scope and scale. So this becomes a lot more easy when they expand into foreign markets. So that gives them an access to foreign, customer base, and where the market size could be large. So that's where the India is a very big example, and a very sought after investment destination, is because of the kind of market size and scope it offers, and companies can definitely get that scope and scale advantage in the long run when they look at expansion of capacities. So coming to the point of the kind of foreign investments that a particular company can make. So when you look at foreign investment, it can be done in two forms. One is in foreign direct investment, wherein the investment goes into companies, and foreign portfolio investment is where investment is made into the secondary market of the country. So under the foreign direct investment, we have greenfield projects, we have mergers and acquisitions, and then we have joint ventures. And then under the foreign portfolio investment, we have the global depository receipts, generally called the GDRs. We have foreign institutional investors, the FIIs, and the foreign currency convertible bonds, which are called the FCCB. So these are the different forms in which foreign investment can flow into the country. So, foreign direct investment is a very important component of a country's national financial accounts. For FDI, is an investment by a foreign investor into the assets of a host country's infrastructure in real estate, ports, rail, plant and machinery. So these are sectors, what do you say, infrastructural sectors which requires huge amount of money and something that calls for deep investments and something wherein the investment is also runs into far too many years, which the local government finds it very difficult to invest. So that's when a foreign company comes is roped in, and they come in and make good of the advantage that the government offers. So FDI does not include foreign investment into stock markets in the host company. So that is treated under the portfolio investment. And FDI for any country of the world is thought to be more useful and beneficial than the investment that it makes in the secondary market through equity and stocks through the portfolio investment. So, three types of foreign direct investments that I spoke about. It can be in the form of a greenfield investment, in the form of a merger and acquisition, and in the form of a joint venture. So, what's a greenfield investment? When a foreign direct investment comes into new facilities or expansion of existing facilities, it is called as a greenfield investment. So, greenfield investments are most welcome in any country of the world, in especially in developed from be it developed or developing, as the primary market of a greenfield investment is to create new production capacity and jobs, transfer technology and know-how in the host country. So greenfield investments are generally investments that a particular company makes in a foreign country right from scratch, right? Where they set up a new industry, they set up a new business, they set up something exclusively new, so from scratch. So they use this particular model called the a boot model, which is called build, operate, own, and transfer. So they build it initially, and then they operate that on their own independently, and then they own it, and then they finally transfer it, which is they sell it to another company, and they go and they can withdraw from the country. So that's a boot model that they do. So green investments are generally very very prospective. So most greenfield projects, you could see that in the field of infrastructure, in setting up a port or setting up a mining infrastructure, or in airport, building an airport. So that's where you can see greenfield investment flowing in. So second way by which an FDI can come in is through mergers and acquisitions. So mergers and acquisitions can happen in several ways, like transfer of existing asset from local firms to foreign firms, whereby local firms can sell their assets. So which is local firms can sell their assets to a foreign company, so the foreign company will acquire them. So that's one way you can do it. So merging is when you merge with another company and you lose your identity. Your firm is now part of another firm. Acquisition is where a bigger organization with huge financial capacity can acquire physical assets and then thereby have ownership of the firm. So that's another way by which companies can do so. Because of this influence of globalization, as I spoke about, mergers and acquisitions have emerged as a very common foreign direct investment route in the last few years, because straight away it gives access to the physical assets of the company, and not just the physical assets of a company. It also gives direct access to the market. So the existing market share of the existing company that was acquired automatically is passed over to the company that acquired. So automatically you get into business right from day one. So mergers and acquisitions are not a very attractive option from the point of view of the host country, as mergers and acquisitions do not provide any long-term benefit to the local company, because as soon as the merger and the acquisition happens, a lot of benefits actually goes back to the foreign company. So the host company really does not, no host country does not really benefit. So in that case, when you look at it, greenfield project is always very very influential and very useful and beneficial, because it not just sets up a new kind of business, but it also offers a lot of opportunity for employment for the domestic workforce. The third type of foreign investment could be in the form of a joint venture. A JV is a sort of a business agreement in which two or more parties agree to establish and develop a new entity for a finite period of time. So the JV is established for a very specific business purpose where both the companies realize that they can do something good for themselves, or they can establish something new and get and be able to manufacture something and then be able to establish their presence in a particular market and thereby able to sell well in a particular given territory or area through a joint venture. So they are able to see that benefit, and that's what makes two companies to come together and enter into a JV, and they can come together and set up an entity and then be able to compete really strongly against somebody who is already a market leader in that particular industry. So JVs are popular in the economies that are opening themselves up to foreign investments. So that's a nice way and a new way for foreign companies to enter. So the merger and acquisition route or a greenfield investment route could be really risky, because if it's a new country and there is not much of information that's available about how companies have what the kind of experience that companies have had with this foreign country, and how the foreign country is going to respond, and what is the extent to which it's going to open up its markets and allow free operations for foreign companies. So if you want to try and test how a particular country is going to operate and whether it's going to be beneficial or useful, then a JV for a finite period of time with a foreign company will always be a good option to take up. So joint ventures are very popular, whereby one party has specialization in one area and they can work together with another party who has a competitive advantage or a core competency in another area. They can jointly work together and then do something good for themselves and then for the market in the larger level. So joint venture will be unsuccessful if both the parties uh, are strong in one area and both are weak in the same area. So that does not work if both are good in just one area and weak in the same area. So JVs are often good for companies that are good in good in two different things. In fact, so one is good in technology, the other is good in market. Market access. So in that case, it can operate, right? So there should be something very unique that both of them are able to bring to the drawing board, and only then JV could be very, very successful. So JV parties coming in must be honest, sincere, loyal, and must possess high levels of integrity, because that's what is going to definitely lead to success of their operations. A JV can be the best way to ensure success of smaller projects which are just foraying into new business or new segments. As I told you, it's always nice rather than taking a plunge independently. It's always better to go through a JV method, because the JV route will definitely help you to diversify risk, help parties who are really strong in two different areas to come together and thereby establish a hold and then enter into a new sector or a new business that could really be very prospective for both of them in the long run. So coming to the second type in which foreign investment flows is through the portfolio investment. So portfolio investment means investment in the secondary market of a country. It refers to any collection of financial assets such as securities or stocks or debentures and bonds and cash. So any investment that a particular company is making into the stock markets of a company by acquiring stocks and debentures and bonds is operating through the portfolio route. Portfolio investment in any country is has to be done using a very high level of knowledge. It must be able to plan, forecast, and judge the potential sectors and companies in which it wants to invest and acquire certain volumes of stakes only in those sectors that are showing a real good growth rate. So that's the only way it could be done. So companies have to be really watchful, careful, and cautious when they make these decisions. Portfolio investments in today's liberalized environment can be held by individual investors or can be managed by financial professionals, hedge funds, insurance companies, banks, and other financial institutions. So it can be done at the individual capacity, or it can also be done at the institutional capacity, by which they can operate by investing in the secondary market of the country. So portfolio investment in any country is made on the basis of the following principles. There are three reasons why they do it. The first one is, yes, obviously the investment objective is there, that you're looking at investing the certain a volume of investment that you're making into a particular stock or into a particular sector in a particular market, and then the expected rate of returns that you're expecting, return on investment, is always topmost of your mind. Second is, um, along with your investment, you're also thinking uh, about the volume of risk that you're going to take. So firms will always want to take up very calculated risks by making enough of investments. So those investments are very tolerant to risk and do not really deplete the financial resources and strength of this particular company if something really crashes in the domestic market, and if investment is not worthwhile enough for them. And thirdly, you're looking at a definite time frame within which you're looking at your return on investment. So companies are always looking at at short-term gains. So that's the primary difference that we're seeing. Companies that are looking at long-term returns and investment, and which are looking at a long journey in a foreign country, or will take the foreign direct investment route. Those who are looking at making short-term gains and then want to buy and sell and operate in a very dynamic, volatile market and see, how quickly they can get their gains, are the ones that use the portfolio investment route. So, what are the different forms in which portfolio investments are done? A very popular route are the GDRs. So, depository receipts are negotiable certificates that are issued by a particular country's bank, which can be held against, which can be bought at a certain number of shares that it holds. And secondly, such stocks can always be traded in the stock exchange of another country. So you hold GDRs and you can sell those GDRs in foreign markets, and thereby you can make good money in terms of the way those stock markets are really functioning. So these are the different of types of GDRs types of depository receipts that we have. The most popular depository receipts are the GDRs. We have the American depository receipts, and we have the national depository receipts, and then we have the European depository receipts offered by the European Bank. So the second type of for portfolio investment that companies make are the FIIs. So the foreign institutional investors are organizations which pool large sums of money and into invest their funds, usually in the secondary markets of a country, buying stocks in the stock market. So investment usually flows into securities, real estate, property, and other kind of asset-oriented investments. So these companies are always going to be looking at sectors that are going to really grow in a developing country. So especially infrastructure projects of late in India have been doing very well. So that's where a lot of investment is made. So FIIs are looking at those sectors where the growth rate is really good. So FIIs may also get registered as companies and target security markets so as to invest their profits to some degrees in these kind of assets in the local company. So that kind of investment can also be made, which means FIIs can also hold a certain stake in an organization. They can hold certain percentage of shares, and whereby they will be able to have a controlling stake, or they will be able to operate in a smaller way depending on the percentage of stocks that they hold, whereby they would be able to influence the decisions that a firm is taking. So in India, these norms are come under the qualified institutional investors norms, and very highly regulated by the Security Exchanges Board of India that regulates the operations of the FIIs in the secondary market. The third type of investment that we have is called the foreign currency convertibility bonds. Another way is, if the firm does not want, if investment is not coming in the form of a GDR, or FIIs are not investing, then another option for them is to buy the bonds, which are these convertible foreign convertible bonds that can be bought by a particular company, and these are issued by countries which can be very easily converted into capital. These bonds can be sold, and then returns can be made very quickly as possible. So, by using FCCBs, a country can raise the capital in the form of a foreign currency, which may be very vital for funding its overseas investments when it is especially running short of foreign capital. So, they can issue these convertible bonds and have foreign companies acquire them, and then with that money, they can go about financing their overseas projects. So this ensures short-term loans for the company, and it helps them to overcome capital deficiencies that they have. These are very freely convertible, bonds that act as debt instruments or equity instruments. So like any bond in the market, it makes a regular coupon and principal payment to investor, and at the same time gives an opportunity to convert it into a stock, into a certain of a company. So since it's very flexible, where it can be convertible easily into currency, where it can also be easily converted into stock of a particular company. So those sort of little free options allows these companies to really operate quite well. So those options make it very attractive, to make these kind of investments. So Indian companies have used FCCBs a lot, especially in financing their overseas acquisitions in recent years. So that's an example of the Indian case. So what are the motives for making foreign investments? There are primarily three motives: the political motives, the competitive motives, and there are economic motives. So the political motive is countries usually do not allow foreign investment mainly because of political motives. So countries which have a colonial past are usually very apprehensive of foreign investment, and are and do not want to allow their businesses to be controlled by foreign companies, or do not want foreign companies to have a certain hold on what they are, on the way it operates within their country. So there may be disadvantages in not allowing imports, as goods from abroad may be cheaper, and this will help in controlling inflation and be cost competitive and better quality. So the point here is we need to understand foreign investment is not always open by all the countries, because for a country like India, which is a developing country, we also have a domestic market. We have a domestic industry, and there is a particular setup that is really working in our country. So when we allow foreign companies to operate within our country, and if in case if it's a 100% foreign direct investment, a foreign company is definitely going to come and set up its business over here, produce and sell, and they may be selling at prices much lesser than what an Indian company can match. So in that particular case, uh, domestic consumers will easily switch over to foreign companies, and it could be a big loss, and it could be a death knell for a lot of domestic companies. So that's one point. The second thing is, if domestic companies go out of the market, then obviously there's going to be a big loss in terms of number of jobs that are going to be lost. So by when domestic companies start closing down, so the government keeps this particular aspect in motive, and then allows foreign direct investments only in those areas where the country is not doing well, or where the industry is not really uh, grown enough to a capacity where it can completely stand on its own and operate. So it allows only in those areas where we require, and wherever we are pretty comfortable, we ensure that that advantage is not given to the foreign company. So the economic motive, obviously, yes, most notable motives for seeking foreign investment is the economic factor. We're looking at foreign investment with more money flowing in and more businesses being set up, and then creation of jobs. So that's an area where we are looking at. So the IT and the ITES, opening up the FDI in IT and ITES has definitely really helped the Indian economy. It's because it's not just helped us to uh, get into the software industry and gain a foothold, and have a big share and a big pie of the global market in terms of software exports that India makes to foreign countries. That's on one side. The other is it has also allowed us to open up our R&D and work a lot more deeper into the research and development facilities, especially in software. And thirdly, it's offered enormous amount of employment opportunities for the local market and for the local workforce. And then the kind of revenue that the government has made is also really exceptional. The third motive, obviously, is the competitive motive. So, competitive advantages that one company will enjoy in foreseeable future in target markets, it's always there. We look at competitive advantage. So, wherever we do not have a competitive advantage, we allow foreign companies to invest and enter. And wherever we have a competitive advantage in comparison to foreign companies, we do not allow that advantage to get lost. So wherever we have a competitive advantage, we tend to export, and wherever we do not have a competitive advantage, if we are depending on imports, and then we would want that business to be set up so that we are able to locally produce and locally sell and become self-sufficient. So that's when we allow foreign investment to come into the country. So keeping it's a mix of these kind of motives. There's a political motive, there's an economic motive, there's a competitive motive. We need to study the market, we need to study the sector, we need to study the kind of consequences that FDI and foreign companies are going to have on the domestic market in the short run and in the long run, and then only accordingly we can make a decision and decide what percentage of FDI to allow and what percentage not. So if you look at the Indian example as such, we open up investment with a minimal of 26% initially, and then we scale that up to 49%, and then we go to 51%, then we go to 74%, and then we finally go into 100%, where 100% foreign direct investment is allowed. So that's how the government operates. Government through its FDI norms allows only a certain portion of investment to come into the market, and then we see how it is working and operating. We study the implications and consequences, and then accordingly decide if everything is very well and good, and if there are a lot of benefits that we are receiving. And then we also allow, that's also a fairly good time for domestic companies to also rise up in competition, so that when we increase foreign direct investment limits, we will have more foreign companies coming in, and we'll also have more foreign investment in foreign companies involvement in the business and in the industry through competition. So domestic companies will have to be really ready to match up to the might of the foreign companies. So keeping those aspects in mind is where companies really decide, how countries really, keep that at the back of their mind when they formulate these policies. So finally, in conclusion, these are the points that we need to understand. We're wrapping up with FDI. Foreign investment, in its very classic definition, is investment by any company from a country making an investment in the form of investment in the building or a factory, or into the investing into or buying stakes in a particular local company in the domestic market. And the second way by which they do it is through investing in the secondary market of a country. So the motives for making an investment, yes, as we said, it gives easy integration to the global economy. It helps in the upgradation of technology and advancement, technical know-how, increases competitiveness, productivity, and also definitely provides a lot of job opportunities for the domestic workforce, and helps in the improvement of the skills of the workforce, which can be of a global level or a world class level kind of employment that we will be able to offer to the world. So FDI is done by making capital investments in greenfield projects, in joint ventures, and through mergers and acquisitions. And foreign portfolio investment, as I said, happens in the secondary market of a country, and this happens through GDRs. It happens um, through the financial instruments, through investment in through FIIs, and through the foreign currency convertibility bonds. And there are three motives that a government keeps in mind when it formulates its FDI policy and norms: the political motive, the economic motive, and the competitive motive. So, in conclusion, so that's what we need to remember, that foreign direct investment is a really good uh, policy or a method by which a particular uh, company can make inroads into markets where it feels that there is a lot of opportunity and a lot of scope. So that in the long run will help the country, will help the company, will help the local market, and then definitely the country can look at gains for itself in the long run when it opens up the markets and liberalizes sectors for more and more companies to operate in the domestic market. Thank you.